You tap a card at the register, triggering a sequence of data handoffs between two distinct financial entities. The latest federal reporting shows exactly what is at stake within this system. Consumers are now driving over $3.6 trillion in annual purchase volume through these channels. But while spending is up, the cost is also rising. Outstanding debt has reached $1.2 trillion, and the average interest rate has climbed to 25.2%. Most cards are chosen based on the familiar logos on the front, but those logos represent different roles in how your money is managed. On every card, you are dealing with both a network and an issuer. Distinguishing between them is the first step in understanding why some cards are tools for rewards, while others are designed to generate interest. Think of the network as the data highway for your transaction. The network determines exactly where in the world your card is accepted and sets the security standards for your data while it travels. The issuer is the bank. They operate the toll booth on that highway. The issuer is the institution actually lending you the money, setting your credit limit, and deciding your specific interest rate. When you check out, the network pings the issuer to ask if you are good for the purchase, and the issuer makes the final approval call. Blaming Visa because you have a high interest charge is like blaming the highway construction company because you received a speeding ticket. Networks operate under two models. First are open networks, like Visa or MasterCard, which partner with thousands of different issuing banks. This setup provides near universal merchant acceptance and standardized security protocols. The trade-off is that you have no direct relationship with the network. Your customer service experience depends entirely on the specific bank that issued the card. Then there are closed networks. Companies like American Express or Discover function as both the network and the issuer. You get tightly integrated service and faster dispute resolution, but you may face limited acceptance because these networks often charge merchants higher fees. Regardless of the network model, both use a universal protocol to protect digital purchases, tokenization. Tokenization protects you by replacing your card details with a unique identifier stored in a secure digital vault. This drastically reduces fraud from data breaches, though it can make canceling a recurring subscription more complex since the merchant holds an active token. Your choice of network defines the physical and digital boundaries of your financial life, where you can spend, and the layer of security protecting that spend. Looking back at the issuers, their primary goal is generating margin through interest and fees. To attract customers, issuers offer premium cashback and travel reward cards, which currently represent the largest share of the market. Issuers fund these perks by charging merchants higher fees and setting higher baseline APRs for the cardholders. If you carry a balance month to month, the cost of that interest will almost always outweigh the value of the rewards you earn. Another strategy is the private label or store card, which is driving recent growth in the credit market. These cards offer easy approval for those building credit, but they are restricted to one store and carry an average interest rate of over 31%. Issuers often design their products to subsidize the benefits for people who pay in full by extracting interest from those who do not. Optimizing your wallet requires a clear assessment of your actual spending habits. If you pay your balance in full every month, you are a transactor. In this case, you can ignore the APR. Prioritize premium issuers on open networks to maximize your rewards and ensure global acceptance. If you are among the 15% of the market making only minimum payments, you are a revolver. Rewards provide no benefit here. You should avoid private label store cards and prioritize low APR issuers, like credit unions, regardless of the network logo. There is also the digital and global spender, who relies on international travel and online subscriptions. You need open networks for worldwide use, but ensure your issuer offers zero foreign transaction fees and robust tools for managing your digital tokens. When you apply for a card, you are entering a contract with two separate entities. The network ensures the card works at the register, but only you can ensure the issuer's terms work for your financial future.